intermediaries. The difference between financial markets and
Before you do take off, the study guide you gave us covers everything that you recommend we study, right? From beginning to end.
No. This is not an exclusive list of what you should study. You should study everything in your notes. The study guide gives you an example question from each topic. There are many other example questions. If you understand this question well, chances are you will do well on the final. This is by no means comprehensive what to study in 9 questions. That would be a very silly thing. Does that make sense? Study everything we went over in this class. Okay, so the review. Financial markets and intermediaries, both of their roles is basically to connect people with extra money to people who need extra money. Okay? Financial markets do this directly, where people with extra money meet people who need money. Financial intermediaries are basically what happens when a person with money deposits it somewhere, and then that institution gives it to the person who needs money. Okay? Both of them are important, and both of them are efficient ways of allocating resources to their highest and best use. By the way, you guys are going to have a hard time writing down everything I'm talking about. I would suggest you guys just try to follow along. You're welcome to write down because this will all be online. It might be easier for you to listen to it that way. But you're welcome to write down what you can, but I'll just be going fast. So, yes, both financial markets and financial intermediaries allocate resources toward their highest and best use. Mario, can you please turn in your homework when you get a chance? So, the next topic we talked about is 2 very important financial markets, debt markets and equity markets. Debt markets, as you guys remember with the infamous horse question, are what happens when somebody borrows something from somebody else. Equity markets are what happens when somebody sells something to somebody else. In the one case, there's an expectation to return the asset. In the other case, there is no necessary expectations for any kind of future exchange. We'll get into the different risk characteristics between the most common debt market instrument, which is a bond, and the most common equity market instrument, which is a stock. We'll get into that later, but just know generally for now that debt instruments are generally speaking safer than equity instruments. So bonds are generally safer than stocks, okay? A few different ways to distinguish markets. We talked about primary versus secondary markets. In primary markets, the party that ultimately needs the financing receives the financing. In that transaction, in a primary market transaction, a company issuing a bond receives the money, or a company issuing stock receives the money. In contrast, in a secondary market, investors transact with one another. So the investor who ultimately invested in Apple during Apple's IPO then goes ahead and sells his share of Apple to another investor. Primary versus secondary markets. We also talked about brokers versus dealers. Brokers are institutions, organizations, agents which connect somebody who wants to buy something with somebody who wants to sell something. They pick up their phones and they contact both parties and they connect them. Okay? In contrast, a dealer works differently. A dealer buys up a bunch of inventory. They don't have to connect. They ultimately connect the people with the asset to people who want the asset, but they will do so by buying up a bunch of inventory. And then the person who wants the asset will just buy the asset from their inventory. Finally, we talked about exchanges. Almost finally, we talked about exchanges and over-the-counter markets. Exchanges, again, are where the person who wants to buy something finds the person who wants to sell something. An example of this is NYSE. We have floor traders where brokers, those are floor traders who want to buy stocks for their investors, will meet brokers who are floor traders who want to sell stocks from their investors. An example of an over-the-counter market is a bond market, where just a bunch of bond dealers, these big financial institutions, hold inventory of bonds. The final distinction in markets we talked about was money versus capital markets. Money markets are by definition short-term. That is the biggest distinction between money markets and capital markets. Money markets are transactions that reverse within a year. So I borrow money for up to a year. Anything over a year is by definition capital market transaction. Okay, so that was chapter 2, the financial market overview. Before we get off that, there's 2 important points to keep in mind. So the benefits of financial intermediation, this is very important. Financial intermediation offers 3 primary benefits. It lowers transaction costs, we'll talk about how momentarily. It provides liquidity services, and it offers a means of risk sharing. So it lowers transaction costs through expertise and economies of scale. One of the most important transaction costs between someone obtaining financing and someone providing financing is mistrust, information asymmetry. Okay? If I can't trust the person who I'm lending money to, I'm going to offer that person a much higher interest rate before I lend him or her money. Financial intermediaries can alleviate or can reduce this cost because they. Questions?
You said experts and what was the second one?
Expertise and economies of scale.
Okay.
So financial intermediaries can reduce information asymmetry costs because their expertise is due diligence ahead of time. They know which borrowers to lend to and which not to lend to, and they provide better monitoring. They can every quarter demand financial statements. Additionally, they reduce legal costs, search costs, enforcement costs, monitoring costs, all that through their economies of scale. They have to type up one loan document versus if I were to lend to Ruben and Audrey were to lend to Crystal and Ismail were to lend to Mario, each of us would have to type up our separate loan documents. Each of us would have to spend legal costs and making sure these documents are foolproof, whereas a financial intermediary just types up one and allocates all the cost across all the different loans that they make. Liquidity services has to do with basically providing us checking accounts. I don't have to go through the slums of St. Louis carrying wads of cash with me because I have a debit card. This debit card basically acts as all of my wads of cash. Anytime I need to pull out my cash, I can just use it, and this way I don't have to physically carry around cash. So this is an example of how a financial intermediary provides liquidity services. Finally, and very importantly, financial intermediaries provide risk sharing. And so this is a means of, the classic example is if I wanted to lend money to Fabian so that he could buy a car, I would have to lend pretty much my entire life savings. Versus if all of us chipped in, gave a little bit of money to a bank, and the bank gives the money to Fabian, that represents a very small portion of our life savings. So this way we all share the risk through the bank. The bank collects all our little scraps of money and can make these big risky loans.
I appreciate that.
Anything? Okay, so there are problems, specifically information asymmetry problems, that banks help reduce. Okay, we talked about 2 kinds of information asymmetry problems throughout this class. We talked about information asymmetry problems that occur before the transaction takes place. An example of this is adverse selection. I don't know exactly whether Mario's reliable or not when he's going to pay me back, but I do know if Mario were super reliable and super wealthy, he wouldn't be asking me for money in the first place. So because of adverse selection, only the borrowers that I would be least inclined to lend to are the ones ultimately asking me for money. So that's adverse selection. Banks can reduce the impact of adverse selection by providing better monitoring. They're better able of screening out whether or not Mario is reliable, and I'm sure he is. So the other problem we talked about is moral hazard, and this is sort of ex post. This is after the transaction takes place. Will the person have any incentive to repay the money to me? So if I'm a private lender, I will have a much harder time hitting this guy up for money. Versus a bank has collections agents, they have the right channels, they have the right resources, they know exactly when to ask that person, hey, you're 32 days late on your payments, we're going to start knocking on your door, all that stuff. So banks can also reduce moral hazard by providing better monitoring services. Okay, that's what we talked about with Chapter 2. In chapters 3 through 5, we began our investigation into interest rates. You'll note that this overlaps with our discussion of bonds. But basically, interest rates can be decomposed into 3 parts. Okay? So our interest rate is RF plus a term premium plus a risk premium. Okay? For now, I'm going to ask you to consider this RF as an instantaneous risk-free rate. Okay? This means the rate that I would charge to give, if I were to give Jay $10 and he would immediately give it back to me. Okay? For that split second, for that instant, I'm foregoing the option value of my money. There would be something that if I could buy in that split second, I could have bought had I not given Jay the money, but because I gave him the money, I can no longer buy it. This is an opportunity cost or foregone option value, okay? In a split second, it's difficult to imagine what that could be, but by definition, that's what this term represents, okay? Then the further out we get, we think of a term premium. And so if I lend Jay money instead of instantly for 3 months, that means for 3 whole months, I could have bought something, but I could no longer buy something because my money is now in Jay's possession. So I have foregone that option value for 3 months. So that rate that I ultimately charge him will command a term premium. And the longer out I go, if it's a year that I can't buy something, if it's 5 years that I can't buy something, the higher this term premium should be. Finally, there's a risk premium. This is the most important component to most interest rates. The risk premium basically is meant to compensate me for the fact that Jay is not guaranteed to pay me back the money. And in fact, if I go pay a homeless man on the street a certain amount of money, I would command a higher risk premium because that person should have presumably a smaller chance of paying me back than Jay. Okay, so what do we use to proxy for this risk-free rate? We don't have any sort of visible, evident instrument that we can interpret as an instantaneous risk-free rate. So we have 2 proxies and both are faulty. Okay? So we use the LIBOR rate sometimes to proxy for the risk-free rate. And this is, you'll recall, the rate that London banks charge each other to borrow and lend funds to each other.
Both times?
Too fast?
No, just what's proxy maybe?
Oh, proxy?
To come up with the rate.
Yeah. This is the best we can do to approximate the words for the rate. Bobby?
Do you have to know how many banks?
No, you don't have to. So the LIBOR rate is the rate that London banks charge each other for overnight borrowings, or at least that's one of the LIBOR rates. They have over 100 LIBOR rates. The problem with that is that London banks are not perfectly default risk-free. So there's still a risk premium associated with this LIBOR rate. So it's not exactly the risk-free rate. It's a risk-free rate plus a small risk premium. Chances are they're not going to fail, but there still is a risk component. We can think about a different proxy or a different approximation for the risk-free rate, which is the T-bill. Okay? The T-bill, you typically use either a 1-month T-bill or a 3-month T-bill. This is a lot more default or credit risk-free than the London banks, but there's a term premium. We only have a month T-bill or a 3-month T-bill. Those are the shortest denominations. So it's not exactly the instantaneous risk-free rate. But these are the 2 instruments in practice that are the closest to the risk-free rate. Okay. This risk premium, you'll recall, consists of many different kinds of risks. I'm not going to write them all on the board, but we talked about credit risk, we talked about liquidity risk, currency risk, reinvestment risk, and interest rate risk. Term premium is pretty easy to understand. It's just the longer out you go, the more I can't use my money. There's not different kinds of term premium. But the important thing to understand about the term premium is the term premium will be positive only in an economy that is not severely deflationary. We took a look at Japanese bonds, and that has a few different explanations, but one of the explanations is that Japan is undergoing deflation. And so why would a term premium be negative if there was deflation? Is because for the same dollar, I could buy more goods 10 years from now than I could 3 years from now. So I will be willing to accept a lower interest rate to lend to somebody for 10 years than to lend to somebody for 3 years, because my money will be worth more to me once they give it back in 10 years than it will if they give it back in 3 years.
So were people you actually said the term premium will be positive only in what?
So a term premium will be positive only in an economy that is not severely deflationary. If the economy is a little deflationary, it can still be positive, but we don't really have time to get into all that. Okay. So then we talked about 4 different credit market instruments. So the 2 instruments are basically 2 sides of 2 coins. The 4 instruments are 2 sides of 2 coins. The credit market, you'll recall, is just the case when somebody lends somebody else money. It's debt over equity. So this happens on the grand scale in public bond markets, or it happens on a micro scale in private loan markets. Okay? So we have a simple loan, which is the first credit market instrument that we examined. And this is basically me giving Fabian $10 and him promising to pay me back $11 2 weeks from today, okay? There's no intermittent payments that take place. By definition, he will have to pay me back more money, otherwise I'm losing money in the transaction. He will have to pay me back more money. And that difference in money is, you can think of it as my interest. So the analogy of that in the public debt market, in the bond market, is discount bonds or zero coupon bonds. So with zero coupon bonds, I pay X amount of dollars for the promise from a company to pay me back $1,000 in the future. By definition, discount bonds are going to sell at a discount. I would never pay that company more money than they'll pay me back in the future, given that they won't pay me anything in between. So to point out, all discount bonds sell at a discount. Not all bonds that sell at a discount are discount bonds. We'll get into that momentarily. The more complex instruments of both the private credit market and the public credit market are, you have a fixed payment loan or an amortizing loan, and these are private credit market instruments where, this is like a mortgage basically, where instead of just receiving one lump sum payment at the end of the term of the instrument, you receive periodic payments all throughout. And the analogy to this is a straight bond, which we discussed in thorough detail. And they're analogous because in a straight bond, you get coupon payments every 6 months. Okay, so we have 4 different credit market instruments. You can think of them as just 2 different kinds, those that pay you intermittent payments and those that do not. One in the private loan market, the other in the public debt market.
And you said that one is with a future value of 0, correct? It pays you in the increments.
So we were talking about fully amortizing loans. In that special case of fixed payment debt, the future value is 0. There can be balloon loans where the future value is not 0. Before I forget, can I borrow your homework? That way I can send it.
Can you just list the 4?
List the 4? Yes, we have simple loans, fixed payment loans or amortizing loans, discount bonds, and straight bonds, or plain vanilla bonds. But that implies something else as well. Okay, now it's time to talk about the price that bonds trade at. Guys, I'll remind you that all this is going to be online, so if you miss something, it's not going to be the end of the world. But you're welcome to. Okay, so the easiest way to analyze how bonds trade is to start with a very special subcase where I will pay somebody $1,000 if they promise to pay me back $1,000 at some future date. If that is the case in this bond transaction, we say the bond is trading at par because I am paying my face value to receive the face value in the end, okay? This occurs only when the required rate of return, how much I as an investor require that company with its risk profile and that term premium to pay me back, if that exactly equals the coupon rate, how much they are actually paying intermittently. Then I will give them $1,000 to pay me $1,000 in the future because I'm getting exactly what I want intermittently. If they are paying me less than I want intermittently, if my required rate of return is higher than their coupon rate, that bond is going to sell at a discount. which means it's going to sell below face value, which means it's going to sell at less than $1,000. Why is that the case? Because I want more than they're actually going to give me periodically, so I will never pay full price for that instrument. Conversely, if I only demand that, if I demand an interest rate of 5% and this company is paying coupon rate of 8%, then I will be willing to pay more than $1,000 for the promise to receive $1,000 in the future because I'm getting more than what I demand intermittently. Okay.
And this is all compared to market rate, correct?
I don't know what you mean.
The percentage of the bond, like it's par if the market,
The required rate of return is the market rate. You can think of that.
Yes, but basically what you're saying that it's par if it's equal to the market rate. It's a discount if it's less than the market rate, and it's a premium if it's higher than the market rate.
Yes, that's right. Okay, and this highlights a very important facet of bond markets is that prices and yields move inversely. If I used to think that this company was so risky that I would demand 5% in interest to lend them money, and now I think that they're even riskier, now I demand 8%, my yield or my required rate of return has increased, right? And if I now think that this company is riskier, what are investors going to buy this bond from me for? If I ever have to sell this bond and the company just got riskier, the price of the bond moved downwards because people are willing to pay less for a riskier instrument. Okay. We talked about one of several points where I'll bring up a very similar equation. Really, all of finance revolves around one equation. This is a sort of version of it, right? So here we're calculating holding period return, HPR, okay? Holding period return of a stock, let's say, or no, let's say a bond, okay, is going to be the price that you sell the bond for if you don't hold it to maturity, or this equals 1,000 if you do hold it to maturity, minus the price that you bought the bond for, so the original price, divided by the original price, okay? This is a comprehensive formula if we're just looking at discount bonds, okay? If instead we're looking at bonds that make intermittent payments, we're also going to have to factor in the intermittent cash flows, okay? So you can think of these as coupon payments here. We're going to scale this also by the percent we paid initially. This gives us our holding period return. Let's say I held this bond for 2.5 years, okay? You would interpret this number as, at the end of 2.5 years, I just became this percentage richer from this particular instrument. Note that this does not take into account any sort of risk characteristics. We're not discounting any of these payments. And note also that this is not annualized. Almost all numbers that you see in finance are annual. Annual percentage rate, annual percentage yield, effective annual rate. So this is not annualized. This is over the entire holding period. Okay?
We're still in chapter 3, right?
We are in chapters 3 through 5. So another formula that we talked about is expected returns. Okay, the expected return of an asset, of course, if it's expected, then it's always by definition ex ante. This is before you get the money. So this holding period return is ex post. We have to know what we'll actually sell it for to know what we got. But ex ante, we get an expected return, and if it's just one expectation, if one thing can happen, for instance, if we're looking at a U.S. Treasury 1 month from now, we effectively think that there's a 0% chance of default, then your expected return is basically the rate of return that they give you, okay? If, on the other hand, we're dealing with two scenarios, we have a company that can either do well or do poorly, we need to take into consideration how much we'll make if they do well, how much we'll make if they do poorly, and the likelihood, we'll call it the probability of them doing well and the probability of them doing poorly, okay? To generalize this formula, we'll say that the expected return equals the summation from scenario 1 till scenario S. There's a total number of S scenarios that can take place. The probability for each index variable times the return in that index variable. So here, S equals 2, and we have a separate, we plug I equals 1 in here. It's the probability of the first one times the return of the first one, and we add, that's what the summation operator does, to the probability of the second one times the return of the second one. If we have 15, then we'll do this 15 times. There will be 14 plus signs here, okay? That's all simplified by using the summation notation.
Are you going to give us any formulas, or do you?
Yes, I will give you all formulas. So, more practically speaking, when we talked about bonds, we need to understand bond ratings. So the thing I want you to understand is that there is 3 to 4 major rating agencies. Each are similar each use different notations, but each are similar in that the top 4 classes of the top 4 rating classes are considered investment grade or safe. Anything below the top 4 classes, I think there's 16 total, are considered speculative grade or junk grade, okay? So when I refer to a junk bond, understand that it means that a bond that is not safe, or a bond that has been rated by any of the 4 major rating agencies as less than the top 4 rating classes. Okay. So the last thing we talked about, or one of the last important things that we talked about in this interest rates chapter is municipal bonds, okay? So we talked about municipal bonds, and we introduced a very important institutional detail about municipal bonds, is that they are tax-free. That is, if I'm an investor and I get $100 in income from my investment in municipal bonds, I have to pay $0 in taxes on that income. So I basically don't have to declare it to Big Brother. And we talked about 2 kinds of municipal bonds. We talked about revenue bonds, where that municipality's stream of cash flows that will feed into a pool of cash flows from which they can pay me all depend on the success or failure of one project. The revenue from this one project will feed me as an investor in their debt payments, okay? And ultimately, if they're able to successfully implement that project, then they will be able to pay back the principal on the bond. If not, they might default, okay? This is the case for revenue bonds. They are more risky than the alternative, which is general obligation bonds. General obligation bonds, or GO bonds, are safer because they are backed by the full taxing authority of the municipality. Sometimes if we're dealing with obscure townships that, just there's 15 citizens in there, maybe those could be a little risky. But to my knowledge, there has not been a general obligation municipal bond. That's a lie. There has been one in Orange County. There have not been many general obligation municipal bond defaults, okay? Most of the municipal bond defaults come from revenue bonds. But still, both classes of bonds, all things equal, are safer than just a general corporate bond that you pick out of a hat. And both are, all things equal, riskier than a government bond, than a federal government bond. So the way you can think about these risks, the risk characteristics of these 4 classes of bonds is government bond is the safest, municipal general obligation bond is the next safest, municipal revenue bond is the next safest, and corporate bond is the riskiest, right? Now this varies corporation to corporation, municipality to municipality, government to government. For instance, a Greek's bond is most likely going to be much riskier than almost any municipality in the United States and most corporations in the United States. But all things equal, if you pull a random government bond out of a hat and a random general obligation bond out of a hat, the government bond will be safer. Okay, and when we're talking about, I'll introduce this when we get to bonds. So, next we moved on to chapters 9 and 10, which was our unit on the Federal Reserve. So we noted that the Federal Reserve has many roles. It clears checks, it redeems damaged currency, it lends to banks, it evaluates bank mergers and acquisition, it conducts bank examinations, and it produces research for people like me. But the most important role the Federal Reserve has is influencing monetary policy. We'll talk about momentarily how it does so. Officially, the Federal Reserve have what's called a dual mandate, okay? They are mandated to keep unemployment at manageable levels, and they are mandated to keep inflation, or to keep prices at manageable levels. So we don't want hyperinflation, and we don't want too much unemployment. The two, there's a trade-off. The book tells you why the trade-off exists. But basically, if you feed more money into the economy, it creates a booming economy, so more people are going to get employed, but it also creates price inflation. So you want to manage that well. But aside from their official roles, the dual mandate, they also have to keep into consideration foreign exchange rates. They might have a target foreign exchange rate that they're going for, and general financial market stability, even if unemployment is reasonable, even if we don't have really high inflation going on, maybe they'll still need to tweak it because of other financial market characteristics. Okay? So the Federal Reserve conducts monetary policy through the Federal Open Markets Commission, FOMC. And this is a sort of committee of Federal Reserve Board members and other members that meet every 6 weeks to set the federal funds rate. They set the federal funds rate by buying and selling securities on the open market. We'll get into the mechanics of that momentarily. Essentially, the more money supply that they inject into the economy, the more the supply of money is by definition. That means the lower the price of money will be. If you think back to your Econ 101 classes, then if you increase supply, price is going to go down. We can think of the price of money as the interest rate. So the more money that the Fed injects into the economy, the lower the interest rate will be. Okay? The interest rate is the interest rate that banks will charge you and me. It's the interest rate that the banks will charge corporations. It's also, importantly, the interest rate that the banks will charge one another. And it's the interest rate that the banks will charge one another for overnight lending. We call that the federal funds rate. So, long story short, if the Fed injects money into the economy, it drops the federal funds rate and generally allows banks to lend more.
Which drops.
Yes. Yes. So, because interest rates are the price of money. We talked a little bit about Fed independence, and we talked about just the debate, is the Fed independent, is it not independent? We talked about, is it good that the Fed is independent if it is independent? Is it bad that it's independent if it is independent? The book does a nice job of going through the pros and cons. I would look at that once. Not the most important thing we've learned, but still valuable. This is important. We went through the Federal Reserve's balance sheet. And like most balance sheets, this has a left side and a right side. And we have government securities is one of the most important assets that the Fed has. And discount loans. Okay? These are the two major asset classes. Of course, they're going to have tons of line items in the balance sheet. So this is not comprehensive. And the main liabilities that it has is currency in circulation and reserves. What do each of these mean? The most intuitive is government securities. Government securities are basically pieces of paper that says the U.S. Treasury owes the holder some money at some date. Okay? This makes sense. Discount loans. The Federal Reserve, as a bank, holds loans that it makes on the asset side of their balance sheet. This is one of the confusing things because non-banks and you and me, when we have loans, it's a promise to pay somebody back money. That is a liability. When a bank holds a loan, or when it issues a loan, when it makes a loan, that is somebody else's promise to pay them back. That is an asset. So discount loans are loans that the Federal Reserve makes to its member banks that are those banks promise to pay the Federal Reserve back. That's an asset. Okay? Liabilities, we have currency in circulation. Currency in circulation is basically the dollar bills and $20 bills and $100 bills and Sacagawea coins that we have in our pockets. And that all represents the Federal Reserve's obligation to pay the person back if he goes to the Federal Reserve and gives them that coin. What will they pay it in? They'll pay it in more coins. Kind of a circular concept.
I have a quick thing, so discount loans is essentially just accounts receivable, we've given you money and we're gonna receive it
Yep.
again, so it's
And
okay.
you can think of loans in a bank as accounts receivable. Basically, they're going to receive some money in the future.
What was that called, the due or
Due froms.
due from?
That's a bank account receivable, right? So we also have reserves. Reserves are basically deposit accounts that that member banks have at the Federal Reserve. Okay, just like you and I might have a deposit account at a bank. For us, that's an asset because that's money that we own. It's just sitting somewhere else. For the bank, that's a liability. That's money that they're holding that they have to pay someone back. Okay, if we extend this analogy to banks, when banks have money that they hold at the Federal Reserve's coffers and in the Federal Reserve's vaults, from the Federal Reserve's perspective, that's a liability. They're going to have to pay the banks back that money, okay? What we call that is reserves. So a bank is going to have an asset on its books that say either accounts payable from the Federal Reserve or reserves or whatever else they want to call it, but it represents the counter transaction to this, okay? This is where it kind of gets confusing. I will try to slow down. When the Federal Reserve conducts open market operations, just give me one. Do we want to do the case where the Federal Reserve sells securities on the open market, or do we want to do the case where the Federal Reserve buys securities on the open market? Buys. Okay? So if the Federal Reserve buys securities on the open market, the Federal Reserve is giving banks money, and the Federal Reserve is taking pieces of paper back in exchange for that money. Okay? How is the Federal Reserve giving banks money? It is dumping money into those banks' reserve accounts. It is increasing the liabilities on the Federal Reserve. To offset that, it's also increasing government securities. It's increasing their assets, it's increasing their liabilities. What these banks are going to do then, now that they have a lot of reserves, the reserve requirements haven't changed, they're going to take that money out of reserves and lend it. Once they lend it, it goes from reserves to currency in circulation. Okay, so this is a transaction that has no effect on the asset side. It's just moving from one liability to another liability. You increase one and decrease the other. There's no offsetting asset side entry. So the Federal Reserve exchanges government securities with the banks by debiting or crediting the bank's reserve account, and then the banks will transfer that money or take that money from currency in circulation. They will either lend less if they buy government securities from the Federal Reserve, then they have to get that money from somewhere. They will lend less, give that money to the Federal Reserve. Federal Reserve will give them government securities. Or in the case that we examined, if they sell securities to the Federal Reserve, they will increase reserves and then move the money from reserves to currency in circulation.
So interest rates will go down?
In which case?
The one that we just examined?
The one that we just examined, if the Federal Reserve puts more money into reserves, the banks take the money, put it in currency in circulation, interest rates would go down. Because there's more supply of money, that means the price of money got cheaper. Okay, and importantly, the interest rate that goes down that everyone's monitoring is the federal funds rate. So that's important to keep in mind. So this is a mechanism through which the government, through which the Federal Reserve conducts monetary policy, and it's how they conduct 90 to 99% of their monetary policy. I can't give you a number, I'm not sure anyone can. But the Federal Reserve also has 3 other conventional tools by which they can conduct monetary policy. They offer discount loans. If they lower the rates on their loans, more banks can have loans, and this asset increases, reserves increases to offset that. That's another way that they can affect the amount of money in the economy. They can affect the amount of money in the economy by toying with the reserve requirements. If you increase reserve requirements, banks have to take money out of the economy and into this account, and or if the Federal Reserve changes the discount rate that they, changes the discount rate that they pay on the reserves, changes the interest rate that they pay on reserves, then it also affects the bank's incentives to keep reserves. It changes the interest rate. I apologize. Okay, and the Federal Reserve conducts open market operations, by the way, through repos and reverse repos. Think about whether it's a repo or a reverse repo as fixing yourself from the bank's perspective, okay? Not the Federal Reserve's, the bank's perspective. So if the bank enters into a repurchase agreement, the bank sells an asset to the counterparty, in this case the Federal Reserve, which it agrees to repurchase. That's why it's called a repo, repurchase. So in a repo, the bank will sell the Federal Reserve government securities. So the Federal Reserve gets pieces of paper, say government securities. In exchange, the Federal Reserve gives the bank money, so there's more money in the economy. And then either next day or in a month or whenever the term is, the transaction reverses. The bank agrees to repurchase, so they do repurchase. Taylor.
So that's in the point of view of the banks, not Federal Reserve.
Yes, the bank.
Okay.
So think of both of these from the bank's perspective. So that's a repurchase agreement. A reverse repurchase agreement is going to be the opposite. Instead of selling the Federal Reserve something and agreeing to repurchase it, the bank buys something from the Federal Reserve and agrees to sell it back to them. Okay, so those are the four conventional monetary policy techniques that the Federal Reserve has at its disposal. There are also three non-conventional monetary tools that the Federal Reserve has used, basically has implemented since the Great Recession. One is expanded lending, so they have different lending facilities. One of the groups I think mentioned asset-backed lending that the Federal Reserve didn't conventionally do and now it started doing. There's a few other different lending facilities that we talked about. And asset purchases or quantitative easing. So this is important. More important than for my class, I would familiarize yourself with the term quantitative easing because if you're going to be in the finance circuit, it's going to come up again. So asset purchases or quantitative easing is when the Federal Reserve not only bought government securities, but they bought mortgage-backed securities and perhaps even other assets from banks. This was a way that they could inject money into the economy, okay? Understand quantitative easing, I guess. And management of expectations. So anytime the Federal Reserve makes a press release, I think they do it once every 6 months, markets move. Markets always move. Markets are always adjust their expectation about the economy based on what the Federal Reserve has said. So Federal Reserve, if it wants to fool people into thinking our economy is good, it will make a good statement. It can make a bad statement and do the opposite. Ideally, it would make an honest statement. That's why markets react to it. Managing expectations. Okay, so we were done talking about the Federal Reserve, and we started talking about banks. So banks borrow money from depositors and lend money to customers, people who get loans from them, right? Their business model runs primarily on the fact that they can pay less for money than they can lend it for, okay? We talked about a bank's balance sheet and a bank's income statement. I'm not going to go over it because I realize I'm already running way over time. So I suggest you guys look in your notes about what makes a bank's balance sheet and income statement different from a corporation's. We talked about CAMELs, capital, asset management, earnings, liquidity, sensitivity to market risk. Those are the different ways that we can analyze how risky a bank is. Keys, one of the most important ones, capital. Capital is basically how well a bank protects itself from the risks that it takes. You can take whatever kind of risks you want. If you have 90% capital, you're not going under. Asset risk is the most fundamental risk to a bank. It is basically, the risk in the loan portfolio and in the securities portfolio. So banks that hold a lot of CDOs and CMOs in their securities portfolio have higher asset risk. Banks that lend to Alt-A borrowers and low-doc borrowers have a lot of asset risk. We talked about liability risk. There's asset-side liability risk. We talked about liquidity risk. There's asset-side liquidity risk, liability-side liquidity risk. They're a bit more nuanced. We talked about the different kinds of regulation that banks are subject to. Banks were historically subject to deposit rate restrictions, got a little looser, branching restrictions, reserve requirements, that's still around. And all these regulatory costs have basically created a breeding ground for a shadow banking system. So people who would bank with banks instead decided to bank with other parties. So they went and got their loans from finance companies, from auto lenders. And instead of putting their money into deposit accounts, they put them in money market mutual accounts. These are both examples of the shadow banking system. Okay.
Money market what?
Money market mutual funds.
Okay.
So, a little more on regulation and regulatory costs. The thing I want you guys to really understand, the biggest criticism for deposit insurance is that deposit insurance breeds moral hazard. Without deposit insurance, consumers like you and me, depositors who have our money at banks, would really be monitoring these banks to make sure that these banks aren't doing anything risky. If the government implements deposit insurance, we have lost our incentive to monitor banks because we know that there's no chance that we're going to incur a loss. So there's less people monitoring banks. So banks can get away with more risk. So the argument goes, deposit insurance introduces more risk into the banking system. We call this moral hazard. In addition to introducing more risk, deposit insurance also comes with regulatory examinations. These regulatory exams are meant to monitor and reduce some of that risk, to mitigate some of those concerns. We talked about some commonalities for the financial crises. So we did bank failure presentations in two different scenarios. We had the SNL crisis, that Bank of New England and First National Bank of Texas failed, and we had the Great Recession where IndyMac and WAMU failed. And I would encourage you guys to look over the slides that I sent you to try to identify some of the commonalities in why banks failed. What caused these crises. What you'll find, I think, is that there were more competitive pressure in both cases. There was financial innovation, and there was deregulation that contributed to some of the failures. And you guys should probably figure out exactly what I mean by those terms. So that concluded our unit on banks. Let's move on to money markets. So money market characteristics.
Okay, deregulation.
It's all on there.
I know, but
So money market character. I'm sorry, I'm just running super low on time. I already got to keep you like 5 minutes late. I don't know. Screw the rest of you guys. But money market characteristics. We talked about by definition they have a maturity, an initial maturity of less than 1 year. Okay, so a 5-year instrument that has 3 months left is not a money market instrument. So they're also usually have an active secondary market. They're also usually issued in large denominations, and they're also usually issued to companies or entities with low default risk. Why do money market instruments exist? This can also be thought of as a reaction to regulatory costs. This was one of the questions on not the homework assignment you just turned in, but the homework assignment before that. Would a company borrow with commercial paper, or would a company do a bank loan, depending on the risk characteristics of the company? So the reason, to reiterate, why financial intermediaries exist is because they add a lot of benefit by reducing the information asymmetry between the investors, the depositors of the bank, and the borrower, the company who needs financing. When there is a lot of information asymmetry for that entity, right? When we're dealing with a small business, for example, there's a lot of information asymmetry, and banks are going to be specialized at reducing that. So the benefit to intermediation through that bank is going to be significant. That benefit comes at a cost. The cost is regulatory burden, right? We talked about different regulatory costs that banks have to incur. Those costs are passed on to you as a borrower through higher loan rates. Those costs are passed on to you as a depositor through lower deposit rates. So when there's not a lot of information asymmetry, the higher lending rate that the company would have to have by financial intermediation, the cost to the company of that exceeds the benefit by the lower lending rate from reduced information asymmetry. The book does a much nicer job of explaining that in the money market section than I can do in 3 minutes, so I suggest you look over that. So types of money market instruments, some common ones: T-bills, federal funds, repos, CDs, bankers' acceptances, commercial paper, Eurodollars. They're all listed in the books. So this is a good segue between money markets and capital markets. As you guys will recall, money markets are less than 1 year. Capital markets are by definition more than 1 year. There are two primary kinds of capital markets: debt markets and equity markets. We'll start with debt markets first. So there are three types of borrowers in public debt markets. Okay? Again, these are public debt markets. These are bonds, not mortgages, not sort of small-time markets. So the three big players in the public debt markets are national governments, local governments or municipal governments, and corporations. Okay? Well, let's examine the national governments first. So the U.S. government issues three broad types of securities: T-bills, T-notes, and T-bonds. The T stands for Treasury. The only difference between the three types is the maturity. T-bills are less than 1 year, T-notes are between 1 and 5, T-bonds are longer than 5 years. The Treasury also issues Treasury Inflation Protected Securities, or TIPS. You had a homework question about that, and I would suggest that you guys familiarize yourself with how to calculate the coupon payments on these TIPS. What I promised to do, that was a very confusing homework assignment the way it turned out, is instead of giving you annual inflation rates that you'll have to turn into semi-annual inflation rates, I will give you semi-annual inflation rates. So I will tell you that the rate of inflation over the first 6 months was 3%. You will have to know that how to calculate the coupon payment is to take the principal value of $1,000, multiply it by 3%, because that was the rate of inflation. You'll get to $1,030, multiply that by the coupon rate, and divide it by 2. Okay? The book goes through examples of that, and I'd be happy to answer any more questions in case when I went through it in class it wasn't clear. So, in addition to government treasury bonds, there are government agency bonds. Okay? This is what happens when Fannie Mae, Freddie Mac, the Veterans Association, Veterans Administration, FHA, when they go out and they just borrow money from public debt markets. This is not to be confused with when those agencies issue mortgage-backed securities. Two separate classes of instruments. Agency debt is not backed by anything other than the full faith and credit of the United States government. So this is basically an uncollateralized promise of a government agency to pay an investor back some debt, some amount of money. So these bonds are effectively just as riskless as U.S. Treasury bonds, because as long as the government won't default, neither the Treasury nor the agency will default. Next, we talked about municipal bonds. I already mentioned that municipal bonds are tax-free. It's an important thing that came up on the test. It'll come up. It came up on the homework. It might come up on the exam. Is when comparing municipal bonds to either government bonds or corporate bonds, it's important to take into account the fact that municipal bonds are tax-free, which means that if you get a $100 coupon payment from a municipal bond, that is equivalent to a 100 divided by 1 minus gamma coupon payment for the corporate bond, where gamma is the tax rate. This on the denominator here is a discount factor. We're basically discounting this by something less than 1. So when you divide something by less than 1, it's going to get bigger. So this number is going to be bigger than 100. That means that you would be indifferent as an investor between receiving $100 from a municipality and this sum from a corporation if this was your tax rate. Keep in mind that for churches and other non-for-profit agencies that don't pay taxes, or for really poor people that don't pay taxes, this is irrelevant. So you can compare the cash flows of the two different kinds of bonds, or you can compare the rates. You can say that the rate that you're receiving from a municipality, let's say this is 5%, is the same as the rate that you would be receiving from a corporation, or the rate that a corporation would have to pay you to be indifferent between their coupon payments and the municipality's coupon payments would be 5 divided by this discount factor, okay? Conversely, instead of turning everything, what we're doing here is turning everything into pre-tax dollars, okay? We can also turn everything into after-tax dollars. We can say, if the corporation gives you $100, you would be indifferent between the corporation's promise to give you $100 and the municipality's promise to give you 100 times 1 minus gamma dollars. Because this corporation's dollars, you will only be seeing 1 minus gamma of it, because you have to pay taxes, gamma and taxes. So, same works for rates, obviously. Basically what we're doing is grossing this up, and what we're doing is grossing this down. You can think of it in either pre-tax dollars or after-tax dollars. It's your choice, but you have to compare apples to apples. Okay, the final kinds of players in the debt markets are corporations, okay? So corporate debt is more interesting to analyze because here we think of credit risk. So we don't typically make a big deal of the credit risk in either munis or government bonds. And we also talked about a few different embedded options that can be issued alongside with the corporate debt. So we talked about call option, put option, and the option to convert. In the interest of time, I can't go over these, but I will recommend that you know how to calculate the yield to call. It's just like the yield to maturity, but you use the first call date or the second call date or whichever one you think it's going to be called in, instead of the final maturity when you're plugging in for N. Okay? It's also important to think about what each of those options does to the final rate, and the way you think about it is thinking who owns the option. If the investor owns the option, then that's going to reduce the rate because the investor is getting something of value, the option, he's going to settle for a lower rate. If the company holds the option, like a call option, that's going to increase the rate. An investor will demand more to give the company the opportunity to hurt him or her.
What were the 3 options?
The 3 embedded options we talked about: call options, put options, and convertible. The option to convert from bonds to stock, from bond to stock. Another thing that a corporation can do to reduce the rate they'll have to pay is get insurance on the bond. So this is what happens when big established insurers agree to make the investor whole in case the corporation defaults. As an investor, you know you don't need to be focused on the credit risk of the ultimate issuer. Now you need to understand the credit risk of the insurer. So that promise is only as good as the insurance agency has money. So it shifts the credit analysis onto the insurer. In contrast, there are also CDSs, which is not when a well-established insurance agency issues insurance on a bond. It's when anybody can issue insurance on a bond. I can write a CDS. That's a simplification, but a lot more people can write CDSs. And so you have to, that's a private investor's agreement to insure the bond in case the corporation can't pay on it. And that promise is only is worth as much as that investor's creditworthiness. The thing I really want you to understand about bond interest income, as this is entirely what makes the topic of corporate finance exist, is that interest income from debt is tax deductible. That means I have to pay, before I pay taxes, I have to pay debt payments, okay? And so my taxable income, my total tax base, of which some will get taken out as tax money, is reduced by the amount of interest I pay, okay? So if we talked about a company's income statement, it'd be worth looking over that discussion. And you'll note that the interest payments come out before taxes come out. This is in stark contrast to dividends. Dividends get paid after taxes get paid. And so this is what makes dividends so unappealing. This is what makes equity financing unappealing relative to debt financing, is because you pay dividends at the corporate, you pay taxes on income at the corporate level, then you get the dividends on this after-tax money, and then you, as an investor, have to pay more taxes on the dividends. This is a concept known as double taxation. So this is one of the benefits of debt over equity, is that debt is tax deductible. So this segues into our discussion of stocks. We talked about the advantages and disadvantages of stocks over bonds. You can find this discussion anywhere, and I'm sorry, I'm really running out of time. I don't have time to go into it, but we talked about one significant disadvantage is the double taxation. We talked about preferred stock and how it's different from common stock. Preferred stock is much closer to a bond than it is to common stock. But the thing is, if it's a bond, then your interest is tax deductible. And if it's stock, your dividend payments are not. So it's disadvantageous for companies to issue preferred stock. If you're going to commit to a steady stream of payments, that's common with preferred stock, you might as well issue a bond and get the tax deductibility advantage of it. That's why you don't see a lot of preferred stocks issued anymore. Okay, I will spend too much time talking about this because this is important. Okay? We have different valuation models of stock. Okay? So P0 is always going to denote the price that you're willing to pay at time zero. And if we're generally thinking about one period, then the price you're willing to pay for a stock in one period is equal to the dividend that you'll receive on that stock, divided by 1 plus the required rate of return on equity, plus the amount you'll sell that price for. So the price at time one, again, discounted back to today. Okay? There's two important components to keep in mind with stocks, is that neither of these two are set for sure, like they are for bonds. So, just as an illustration, I like to write these expectation operators on. Okay? Another thing to keep in mind is that this assumes that everything's going to take place in one period. Okay? Let's say you only get one dividend at period 4, and you dispose of this stock at period 7. Okay? Then we're going to have to discount this by 7, discount this by 4. Okay? Assuming that the required rate of return is the same. What you're calculating, so in a multi-period model where you're not just receiving one dividend and selling at one point, what we have is price at 0 equals the sum of these expected dividends from I equals 1 to S. Let's say you hold on to it for S periods, divided by 1 plus required return on equity on indexed by I, plus your expected disposition price at time period S over 1 plus R to the S, because you're receiving this cash flow at time period S. Okay? So this is the general case that will allow you to value any stock. The problem is that what if you have no intention of selling this stock? This is a company that's going to live to forever, and you're an investor that's going to hold it as long as you live. There is no disposition cost, okay? And in the very simple case, when you're going to hold, this company's going to live forever, you're going to hold the stock forever, and we know for certain that all the dividends are going to be the exact same amount. What you're willing to pay for the stock is the next period's dividend divided by just your discount rate. So instead of discounting this, this is the special mathematical way we discount. Okay? Instead of using the 1 plus RE, it's just over R. You can think of this as a special subcase of a broad model that includes growth. So again, the price at time 0 equals the dividend at time period 1 times R minus G. This assumes a constant discount rate, constant growth rate, and a constant dividend rate. Dividend value, not exactly rate. Okay? So this is a subcase of the model below, because when the growth rate is 0, when you get the exact same dividend, there's no growth, then it's R minus 0, it's just R. Okay? So these are the relevant formulas that you need for valuing stocks. Again, I will give you each of these formulas on the test, but come prepared on how to use them. So after we got done talking, there's nothing else I want to talk about stocks here. We talked about the difference between NYSE and NASDAQ for a bit. I'll leave that for you guys to refresh yourselves on. After we talked about stocks, we talked about mortgage markets. And what distinguishes a mortgage from any other type of loan is a mortgage is by definition secured by real assets, means secured by a building or a car or something that's tangible, not all business assets or not goodwill or something like that. We talked about some different characteristics of mortgages. When you're talking about mortgages, you got to talk about the term of the mortgage, how long it's going to be. You got to talk about the rate on the mortgage, but unique to mortgages and unique to residential mortgages, we also talk about points. And as you'll recall, a point is 1% of the total amount that you're going to borrow from the bank. Okay, this came up on some of your homework questions. What banks look at when they're lending and when they're giving mortgages, a couple things. So first they look at your FICO score as a proxy or an approximation of how creditworthy you are, but they also look at your capacity to repay. If you make a lot of money, you'll have a higher capacity to repay. So the way banks adjust for this is they have these rules on debt to income ratios. So they have a rule that says your total monthly debt payment or your total annual debt payment cannot exceed your total monthly income or your total annual income. Cannot exceed X percentage of your total monthly income or your total annual income. That percentage is usually set around 25 or 33%. And so you work with a problem like that. That is the debt to income ratio. There's also a loan to value ratio. It has to take into account how much the house is worth. So banks do not like making loans to people for more than 80% of what the underlying collateral is worth. Okay, so a typical loan to value ratio is about 75% or 80%. Again, you had a homework question on this. We talked about private mortgage insurance and why it decreases the rate on the loan. We also talked about the different agencies that will insure, the VA and the FHA, that acts the same way. Know what amortization is, know that you can have fixed or adjustable rate mortgages, and understand who prefers fixed rate mortgages. Does the bank or the consumer prefer fixed rate mortgage? Does the bank or the consumer, prefer adjustable rate mortgage? We talked about different other types of mortgages that exist, but I really don't see a question coming out of that or that being particularly useful to you for your lives. Okay. Finally, yes, we actually got here. Yeah. Finally, we talked about exchange rates and currency markets. Okay. So we talked about the law of one price. In the strongest form, the law of one price basically states that I should not be able to buy an asset in a foreign economy, come home and sell it and make a profit. I should also not be able to buy an asset in a local economy, go overseas and sell it and make a profit. Why should that not be the case? Because the exchange rates should be such that it would cost me exactly as much money to buy that asset, that exactly equivalent commodity here, as it would to change my dollars into yen and go and buy it in Japan. We talked about the limitations of the strongest form of the law of one price, that the prices have to exactly equal, is that this doesn't take into account transaction cost. Ruben pointed out that we have transaction costs when you're exchanging money. This homework question asked you to think about the transaction cost of actually going from one economy to the other economy. You're going to have to pay some transportation costs. And so a weaker form of the law of one price says that after you account for transaction costs, there should be no arbitrage opportunity to buy a good in one economy and then incur those transaction costs, sell the good in another economy. Okay, that's what your homework asked you to solve in the Jupiter and Saturn problem. How does this mechanism work? Well, if there ever is a mispricing, quote unquote, what will happen is these sneaky hawks and dogs of arbitrageurs will swarm into the market and find this arbitrage opportunity and immediately start buying and selling on it until the price is correct, or until the exchange rates equalize to the point where those arbitrageurs can no longer do this arbitrage. We call that purchasing power parity. The concept of purchasing power parity is that exchange rates will fluctuate toward the point where there will be no such arbitrage opportunities and the law of one price will hold. Okay, another important thing that we talked about that your homework asked you about was exporting countries and importing countries. Who wins if their currency gets reduced, if their currency devalues or depreciates? So in an exporting country, a country that relies heavily on exports, what happens when their currency depreciates? That means people from other countries can buy more of their currency than they used to be able to. Okay? People from, if I'm Norway and my currency just depreciated, that means somebody from Thailand can buy more of my currency than they used to be able to buy before my currency depreciated. And if I'm Norway and a huge exporting country, then I'm going to be happy by that because more people can afford my exports. My economy is going to boom. Conversely, if I'm a net importer like the United States and our currency depreciates, that means everything that we used to buy, we still have to buy, but it just got more expensive. We're going to be bummed about that. Okay, so exporters win when their currency depreciates. Importers lose when their currency depreciates. Understand the mechanism by which that's true. Okay, know how to calculate the percentage appreciation and depreciation. I asked you to do that on your homework. Okay. Just one facet of currency exchange markets is that they're basically run by huge traders, these giant institutions that make giant trades. So you and I can't really do a lot of currency trading ourselves. We can put in our trade through these big brokers and they'll do it for us, but there's transaction costs for us. Okay, the final thing that I wanted to get to just to make sure everybody saw it, I sent you guys an email about it. I did an absolute crappy job of explaining it to you the last time I lectured, and so I will try to improve, but it is basically how changes in different factors affect the exchange rate, okay? So we'll draw out the same graph we have. We have factors. By the way, this is in your book, and this is in the email that I sent you, but I'll do it here for illustrative purposes. Delta denotes change in math. What is not necessarily in your book, which I want to communicate to you, is think about all of these factors changing and how they impact local demand, that is demand for local goods. So, and then the exchange rate of how many units of foreign currency we can buy with 1 unit of domestic currency. Okay, so the factors we talked about are domestic price levels, trade barriers. Keep in mind that you can think about trade barriers from either perspective. So when I say trade barrier for this example, I will mean the domestic country, the trade barrier that the domestic country sets, not the trade barrier that the foreign country sets, because that's also relevant. So I'll say domestic trade barrier. Import demand, export demand, and productivity. Okay, so in all of these, we're going to think about what happens if these factors increase. That is, if domestic price levels rise, if the United States creates more trade barriers, if we want more Japanese goods, we have higher input demand. We want, Japan wants more of our goods, we have a higher export demand. And we have more productivity, okay? So the change is always positive in my example here. So what's going to happen to the demand for local goods if domestic prices increase? Okay, if domestic prices increase, we're going to want less of our goods relative to foreign goods. If we have two identical commodities, I can buy them here or in Thailand, and the prices here increase, I'm going to buy more of that commodity in Thailand. So demand for local goods decreases. What happens if domestic trade barriers increase? So we have two identical goods, and it just costs me more to purchase it from Thailand because we created these import taxes from Thailand. This is an example of a tariff or a trade barrier. So I'm going to want more of my own goods and less Thai goods, okay? So demand for local goods is going to increase. What happens if Thai coconuts that I'm buying, if these Thai coconuts that I'm buying have been revealed to be much healthier for you than the U.S. domestic grown coconuts? Well, there's going to be more import demand. I'm going to have a stronger preference for Thai coconuts, and my demand for local goods, relatively speaking, is going to decrease. Okay? Export demand, what happens if Thailand decides that U.S. coconuts are the best and they're no longer going to make coconuts, they're just going to import all of their coconuts from the U.S.? Well, the demand for our goods is going to increase. Okay? What happens if Monsanto produces this new technology where we can now grow 68 coconuts per tree instead of 47? So productivity increased, we're able to get more coconuts. That means the price per coconut is going to decrease. That means demand for coconuts is going to increase, right? Okay. A simplification, this will not be good enough for your exam, but a simplification is this ratio of foreign to domestic always moves exactly like demand for local goods moves. That's why I asked you to think about this intermediate step, demand for local goods. So I'm just going to write out the arrows real quick, and what I'll do a better job at explaining is the mechanism through which this works, okay? So a change in any of these factors, an increase to any of these factors, let's pick a factor. Which factor do you guys like? Trade barriers, okay? So increased trade barriers shifts demand for local goods. In this case, it increases demand for local goods, okay? But because local goods can only be purchased with local currency, it's going to increase demand for local currency, okay? If more people want this local currency, this currency is going to become more valuable. That's just the definition of value. How much do people want it? How much do people like it, okay? So local currency becomes more valuable if more people want it, okay? If the local currency is more valuable and more people want it, it can buy more things. More people are flooding into this currency. People like this currency because it can buy more things, okay? Some of the things that this currency can buy is other people's currency. If U.S. currency becomes more valuable, if the U.S. currency appreciates, sure, we can buy more Japanese cars, we can buy more French snuff, whatever it is that we buy. We're going to be able to buy more, but we're also going to be able to buy more euros, and we're going to be able to buy more yen, and we're going to be able to buy more baht and more pesos and everything else, okay? So the ratio of foreign currency that you can buy for each unit of domestic currency is going to increase because your currency became more valuable, because demand for your currency increased, because demand for goods produced in your economy increased, because this factor changed. So, that concludes 16 weeks of our lives. Any questions? I promise you I'd answer questions afterwards. There's probably a lot.
Can you explain because on the second for the last homework, just comment I said on the right page. The first one of this basically. I can't remember which problem it was. It was the second to last one.
Oh, gotcha.
It's not
Okay.
really relevant.
Yeah, I've sent you, well, right now I'll hit the send button and I will send all of you guys a copy of the answer key, and you all know it, but after I do so, anyone who wants to stay can see me explain this.
Would you suggest learning the foreign exchange market, kind of the?
All you gotta do is go to that old link and it should be,
Yes.
it'll be in my videos.
I think that would really help you develop some intuition for it. I'm not going to promise
already-
that I'll ask a graph
it's already
question.
up
It might be a good question. I have to think about it. But yeah, I'd say that would really solidify.